This is the Evidence-Based Investing Podcast, the show that challenges assumptions and puts every strategy under the microscope. We bring in the experts, we bring the facts, and we break down what actually works depending on where you are in your wealth journey. If you want hype, this isn't your podcast. If you want the truth, well then welcome aboard. The information in this podcast is for educational purposes only and does not constitute financial, tax, or legal advice. We discuss general investment concepts and share case studies, but your personal situation may be different. Always consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results.
Welcome to the Evidence-Based Investing Podcast, powered by Retained Property. I'm your host, Luke Ryan, and today we have a special guest with us, Naj Elsayed. Naj is a real estate agent at Town Group. He's an entrepreneur, property investor, dad, and he sold his first company for 7 figures while he was still in his 20s. Naj, welcome to the show.
Thank you. What an intro.
Got that one, mate?
Loved it.
Pump you up.
Absolutely.
So, mate, look, in today's episode, we're going to go through and dive into some key topics. Now, obviously, you're a real estate agent, I'm a buyer's agent, so I want to talk about how buyer's agents and real estate agents are collaborating, what you think, and then we'll jump into the rise of the industry and the perceptions of buyer's agents to real estate agents in the industry, because I've had some mixed reviews personally myself. And then we'll dive into some investor activity on the Sunshine Coast. Then jump into some Q&A, some frequently asked questions. How does that sound?
Sounds good.
Okay, so how many buyer's agents are you working with on average now, do you reckon? What percentage?
I'm talking to, half a dozen frequently, every week.
Yep.
And, there's a lot more coming through opens and introducing themselves. I meet a new buyer's agent most weeks, one, 2 or 3 a month, I would say.
Right.
Yeah.
And are they investors focused or are they buying a PPOR?
Probably about 70% PP.
Yep.
30% investor.
Yep.
Yeah, our product is probably, I guess, testament to that.
Yeah, fair.
A lot of our stock is probably geared more to an owner-occupier than an investor.
Yeah, absolutely.
But we just saw one in Budrum that has a very high yield, dual occupancy. That was online for 6 weeks, and I probably had 3 buyers agents come through that.
Okay.
Yeah.
Any interstate?
Yeah.
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 And interstate buyers agents, they're only calling and sending through a property manager, or everybody's on the ground?
Sorry. So interstate buyers.
Yes.
Using local buyers agents.
Yeah. Okay. Yeah. I guess it's quite different though. Like you said, you're in that 1.5 plus range typically, aren't you?
Yeah. Not always. Like actually, we've got a unit at the moment in Bedina, 3-bed, 2-bath in the mid-8s.
Okay.
Cracker.
Yeah.
We had 3 buyers agents come through the very first open home on that.
Right.
So yeah, but to your point, it's property specific.
Yeah, absolutely. Yeah. And in your circle, with your real estate agents, what's the general consensus? There's some good, there's some bad, some are annoying.
Man, not really.
Okay.
I love them. I love working with buyers agents. I've used a buyers agent. I see a lot of value in buyers agents. There's a lot of real estate agents, sales agents that do use buyers agents.
Sure.
They're great to deal with.
Yeah.
The average buyer really doesn't make it that easy for a sales agent. Like you try and provide the best service you can, and it's difficult because they don't know how to communicate efficiently.
Yeah.
There's buyers who you'll try to service and, they don't communicate or reply or anything until they need you or until it's too late.
Yeah.
A buyer's agent is very easy for us to.
Yeah, and I suppose because they understand the process, right? So they've already spoken to their client, which is the buyer, and they've geared them up for, okay, this is what's happening and this is what's going to happen next. So we can have those conversations a lot quicker than what you typically can.
Yeah, and it's not even because they it's helpful that they know the process, but I am more than happy and comfortable helping somebody who doesn't know the process.
Sure.
It's just, the effort more so.
Yeah.
The effort they go to communicate and be, present.
Yeah. Well, the professionals, right?
Yeah.
We don't want to piss you off.
Yeah.
You're a pretty key part to what we're trying to do.
And people are busy.
Yes.
They're not communicating effectively with me because they're trying to run a business and a household and wrangle 3 kids.
Yeah.
Potentially.
Yeah, totally. Yeah,
so obviously your sales agent may not get prioritized.
Yeah. Totally.
But no,
Makes
overall, man, I'm a big fan, and
Good.
I'm also a big fan of the value they provide to the average person. I think more people should be using buyer's agents.
Yeah, so let's jump into that. You used a buyer's agent.
Yeah.
Where did you purchase?
Caboolture.
Yes. How long ago?
4 years. Just ticked over 4 years.
And would you have found that property, and how did it perform?
It was off market.
Okay.
I wouldn't have found it.
Yep.
It wasn't a massive saving at the time, but it was a genuine off-market opportunity. Had it hit the market, it probably would have sold for $425 to $435 at the time.
And what did you pick it up for?
We secured it for $405.
And what's it worth today?
$8.
Not bad. Hey.
I could sell it tomorrow for $785.
Yep.
Staged with a good campaign. I think it'd hit $8.
So basically double in 4 years.
85 to 90% in 4 years.
Definitely beats the Australian average. Yeah, that's great. And that was just straight up for an investment. You were never going to plan on living in that?
Absolutely. Yeah. I could just see what was happening, You hear about a housing crisis in Brisbane, you hear about a housing crisis in the Sunshine Coast, where are all those people going to?
Yeah.
Be pushed.
Made a lot of sense, absolutely.
It made so much sense, man, and it's been cash flow positive since day one.
Yeah, that's great.
And I worked out, I think if you can find something that's cash flow positive.
What was your LVR on that?
It was I couldn't actually get finance at the time.
Okay.
So
you paid cash for it. It's pretty easy to be positive then.
I had to settle it with cash at the time,
Okay.
and then I was able to get my money out of it at 80%. But by the time I did that, they valued it at close to $5.
Yeah, right.
So I paid $405.
So you had all your money back.
I paid $405, refied, and got $430 out.
Yeah, that's unreal.
Yeah.
And how long was that process?
A year.
Yeah, that's
max.
That's amazing. That's really good going.
Yeah, I could just the metrics just didn't make sense. It just had to go up, in my opinion.
Well, look, affordability is one of the massive things that we look at.
Totally.
Right? So,
yeah.
And look, that's what you sort of see quite often. That the affordability will push out from the central CBD area where the main post office boxes are.
Yeah.
And they catch up.
Yeah.
Not always the case, but yeah, like affordability definitely drives the market. It's a big indicator anyway.
And the big, I had it under contract, and I was thinking, damn, am I really about to buy a house in Caboolture?
Yeah.
It still felt a bit weird. And I spoke to someone who lived in Yandina Creek and worked in Caloundra. And she did the math, and she goes, that house would be closer to work for me.
Yeah.
It's just up the road.
Yeah. And that highway's so good too. Hey?
Yeah.
It's only, 40 minutes at the most, right?
40, 45, yeah. From Caloundra anyway.
Yeah. Yeah, great. That's good.
Ask someone from Sydney if they're happy to live 40 minutes from work, and.
And would you buy another investment property smack bang in the middle of the Sunshine Coast now, or you think you'd probably go out to those more affordable markets or somewhere to stay?
It depends. Me personally, I would try to find the next kind of Caboolture, the next suburb that's set to go up 80% in the next 3 to 5. You could probably assist in finding that for me.
Yeah.
An investment on the Sunshine Coast, I would be very picky.
Yeah.
We've got a unit in Bedina at the moment, 3-bed, 2-bath, in the mid-8s.
Yep.
I like that. I'd buy that.
Yep.
I would buy in Kaluan. I'd buy a standalone house in Kaluan, Nambour,
Sydney Now's got pretty good data at the moment.
Yes.
Probably one of the better ones.
Yeah, it's up there though, you know.
Yeah.
Like comparatively speaking, I think
Absolutely.
it's kind of, you know, not done its dash, but it's bumped up. But yeah, I think people are sleeping on Sippy Downs, Mountain Creek, like Brightwater, you know.
Yeah.
You're behind Kawana and Mooloolaba, and you
Yeah.
can still get a house in there for, you know, low ones, like a nice,
you
decent
can,
house
yeah.
for low ones. Like,
Yeah.
you know, I think that's underrated. But yeah, from an investment point of view on the Sunshine Coast, I'd be real fussy.
Yeah.
Yeah, I think, you know, there's better spots.
There's better spots for short-term capital growth, I think, for sure.
Definitely,
I
yeah.
think that there's a lot of other areas where there is better opportunities, where you're sort of sitting at the bottom of the property clock, as they say, you know. We've obviously just been through like a massive boom here. So the affordability is starting to hit a bit of a friction point where, you know, I mean, the average days on market, the average affordability is 72 years to own, they say, which how that metric is it comes across is how they calculate that metric is they look at the median household income, and then they look at the median house price, and they say if 80% if they spent 50% of their income
Yeah.
on the mortgage repayments at an 80% loan to value ratio
Yeah.
on a P&I loan, how long would it take them to pay off?
Yeah.
And it's like on average 72 years to Sunshine Coast. Where if you go into areas of like Melbourne at the moment, which is all the hype,
Yeah.
you get stuff at like under 35 years. So just that affordability component, you know, like obviously there's a lot of people with a lot of cash in their properties here on the coast at the moment, and it's like it's definitely not dropping anytime soon because it's got.
And what's that metric in some of those outer Melbourne suburbs?
Yeah, 28, 30,
Wow.
33 years, you know. So, I mean, like, you know, we've just got a property under contract right now, actually. We 580,000, 700 square metre block, room out the back for a granny flat. You know, it's an older home and it needs a little bit of work, but you can't even get a unit here for that.
Yeah.
And don't get me wrong, it's like, it's a different area, right? Like the socioeconomics of the area are not what the Sunshine Coast are.
Yeah.
But that affordability component means that there's just more owner-occupiers in the market that can afford it and can move on and keep buying.
And how far from Melbourne?
This one would be about 40 kilometres.
Okay. Yeah.
Not too far.
No. Yeah. Accessible.
Yeah. I mean, it depends where you're staying in Melbourne, but yeah, like it's not too far away at all. Like socioeconomics are good. Yeah.
Do you want to talk specific suburbs?
Yeah, that one there is in Hoppers Crossing.
Oh yeah.
So it's like, you know, like the socioeconomics of the area are like okay. It's just starting to heat up now, but you know, we sort of think that that's going to have really good growth in the next sort of 5 to 7 years, and on a percentage basis, I would say probably more than the Sunshine Coast. But
Yeah, exactly.
and like the other thing you got to look at too, right, is depending on how much income you're making, will very much change what your serviceability is from the bank. And if you're having to max out here on the Sunshine Coast, and that limits your ability to be able to buy again, because even if it does go in value, you haven't got the serviceability to be able to pull that equity out. That's going to stunt your growth. So often it's better to get 2 or 3 $600,000 properties than it is to get one $900,000 property. And if you structure them right, you can actually leverage yourself a lot harder by doing it that way.
Totally.
By
Yeah.
utilising things like trust structures and whatnot.
Yeah, I think about my property journey and where I'm at now, and obviously I've done pretty well.
Yeah.
And I'm in a decent position. I genuinely think if I went more along the lines of that rent vesting and, you know, buying in key suburbs each time, I'd probably have a much larger portfolio than I do now.
Yeah, I mean, the numbers don't lie.
And like the opportunity, like I'm screaming about it from the hilltops to anyone who will listen, you know, if you're priced out of the market on the Sunshine Coast and you're renting, keep renting.
Yeah.
Buy somewhere else. Engage someone like yourself. And, you can literally get a property a year.
Yeah, you can, and look, people do, and they do it on modest incomes. If you like, I mean, the way that you can structure it, and don't get me wrong, there's like risks that are involved.
Totally,
in doing it. There's a reason why there's legislation in place and why they put their buffers on the interest rates. They put 3% buffers on interest rates. They shade the rent by 20% when they do the bank calculation. So, if I give you an example, right? Say you're got an investment property that you're renting for $1,000 a week, 52 grand a year, right? They're going to shade that by 20%. So now your 52 grand is circa $41,000 that the bank will say is income. And then say that your repayments were $40,000 on an interest-only loan. They're going to add a 3% buffer. So say if it was on 6%, that 40% goes to $60,000. So all of a sudden, as far as the bank is concerned, you're making $32,000 less than what you really are, right? And where that really, this is why people get stuck on second, third, fourth property, right? Say you're on 150 grand and then you buy a property and it is actually neutrally geared, right?
Yeah.
It isn't costing you any money. The banks won't see it like that in your personal name because they put their buffers in place. So all of a sudden the 150 is 120, then your 120 is 90, your 90 is 60. You ain't getting any money for 60 grand income.
Yeah.
And you could still be making the $150,000 and have everything neutrally geared. So the ability to be able to put them into the trust and to silo those debts is the vehicle that a lot of people are using.
That's the optimal solution, do you think?
Not for everyone.
Yeah.
No, like it's got its risks, right? Like it's more risky. If interest rates do go up, that extra 3%, and you haven't factored in your buffer, like you can get stuck. And if you're not actively maintaining and looking at your portfolio and checking what your cash flow position is, which most people don't, right? You can find yourself in a situation where you're in a lot of trouble. But you can. You can do it. People do it. And the people that have built the biggest property portfolios have all adopted those strategies.
Totally.
Yeah. All right, so I'm going to jump into a question for you, Naj. Why buyers shouldn't be scared at an auction?
Oh, man. I love auction.
Yes.
As a buyer and as an agent, I love auction.
Good fun.
It's transparent. Everybody's there. You can see what's happening. As a buyer, I would way rather be at an auction than in a multi-offer situation. A multi-offer situation is where there's more than one buyer who has submitted an offer on a contract to purchase the property. That process for us as sales agents is basically issuing a multi-offer form to every buyer, whether it's 2 or 10, and explaining to them that they get one shot. There's no open negotiations. We can't be in active negotiations with more than one buyer because we've only got one property to sell.
Best and final.
Best and final. Everyone make your best and final.
Yeah.
Well, where do I need to be? I can't tell you.
Yeah.
And we're not allowed to tell you. Well, what do I? No one wants to overpay. No one wants to actually give you their best and final, and they never do. And at the end of a multi-offer, everybody hates us except that one buyer who was able to secure the property because, we do the right thing, we abide by legislation, but people are angry that they missed out. Take those same 4 buyers and stick them in the front yard and they're all bidding up. They can bid up as much as they want. It's transparent. They know where the other buyers are. There's no better way to buy a property.
Do you find it does take some buyers off the cards though, just because they are scared that they're going to get the finance through? And
so, sort of, somebody who's genuinely too scared. Yeah, they may not come along. Generally, if people want the property, and they have their pre-approval and they're happy with the building and pest, they're happy to bid. That does take a little bit of hand-holding, especially, first home buyers or people that maybe haven't bid in an auction before. Like I've had conversation with buyers who have said, I can't come to this auction. I don't have $1 million.
Yeah.
Genuinely thinking they needed $1 million cash in the bank to bid at the auction.
This is also a very big role that the mortgage broker should be helping with too, though, right?
Bro, mortgage brokers just love wrecking deals. Mortgage brokers and conveyancing solicitors.
I've seen some shockers. Hey, I've had some conversations with, well, I've had a lot of conversations with clients where, you know, like, have you got a mortgage broker? Yes. Okay, cool.
Yeah.
We're going to go into the strategy session. Can you please go and get, you know, this, and this, and they just go back and come back and say, oh no, you're best just to buy a property like for yourself. It's like, well, no.
Yeah.
Like this, like maybe they are, but
yeah,
there is more to it than that.
Yeah.
Yeah, it's massive.
You're right. You know, there should be a little bit more, I guess, onus on them. But I don't know. I don't know what conversations they're having or not having.
Yeah.
But once you explain to somebody, no, you don't need $1 million cash in the bank. You need to be confident that you can get finance before settlement.
Yeah.
They go, oh, okay, cool.
Yeah.
You know, and we've proved that. Like, we had an auction. The price point was in the sevens. You know, I had some people telling me that was silly to take a house in the sevens to auction because it was first home buyer territory. We had 8 registered bidders, 4 active. You know, it took a bit of extra work. It took some hand holding, like I said, but it was a great result. We you know, 50 grand over reserve. Everybody had a lot of fun, and it was actually a buyer's agent that got it in the end.
Yeah, there you go. Eh?
But no, you know, auction to me is a far better platform and a far better position for a buyer to be in than a multi-offer situation.
And I think in Queensland too, they do have the best rules where you can't disclose the price. What we see in some other states where they do give price guides is just like completely undercooking it.
Yeah.
I was watching an auction the other day. It was a guy that I know, he's a buyer's agent, and he was bidding down there, and the price guide was between 650 and 700 grand for the auction, and like we both knew it was going to be closer to 8, right?
Yeah.
It just was, and he what he did is he went in there and first bid just came in at like 780. And like you just watched the room just clear out.
Yeah.
But it still went up. It still ended up going for like 805. Like he didn't actually overcook it. But
okay.
That was like just strategy that he put in place because they're getting all these people in saying, thinking that they're in the price range. It just blew them away and got rid of some of that competition early on. Yeah.
No, I agree. I like, you know, I don't dislike the Queensland legislation. I dislike the way some agents use it. You know, we're not allowed to give a price guide, but we are allowed to give comparables, and we should be, which is ultimately the same thing in a different a different form. But there's a lot of agents that don't, and just kind of, you know, leave you to it.
Or say, come along, you should be good there today. You should turn up, definitely.
Yeah, and, you know, and there's probably a lot of frustration with that, you know, if you're a buyer that's been to 5 auctions thinking you could, you know, thinking you were in the mix, and every time you've been 100 grand behind the mark, I can see why you're going to get frustrated.
That's why they should use a buyer's agent.
Totally.
Yeah, I mean, like, there's no real substitute than just going on to realestate.com.au, having a look at the map, look at the last 3 months' sales, click on all the ones around it, put your filters in place, and try and find comparable properties. Like
the data's there now.
Yeah.
You know, it's not difficult for, you know, the average person to figure out roughly what a property should sell for, especially once they've walked through it. Yeah.
And like, be honest with yourself. Don't kid yourself with the numbers, right?
Exactly.
Like, if there's one down the road that's almost exactly the same for $1 million, you're not going to get it for $900. $900 grand.
Yeah. And, you know, like, we're always going to auction properties that we feel are going to be competitive and popular. So there is going to be competition, and, you know, competition generally will drive the price up.
Yeah, absolutely. Righto. All right, let's jump on to the next one.
So before the show, we were talking about slicing the data and regression analysis. Let's talk more about that. How would you explain that to someone that's never heard of anything like that before?
Okay, so I'll start with what a regression analysis is. Regression analysis is basically, okay, so you're looking at supply, you're looking at demand metrics when you're looking for hot spots or warm spots for suburbs around, right? You're looking at socioeconomic scores, you're looking at the affordability. And what you want to try and understand is, okay, it's all well and good saying days on market is 28, or stock on market is XXX. But what's more important is that it's actually trending down. But then once you actually understand what the buyer's brief is, say they've got $700,000 to spend, you want to be able to go back in time and have a look at what did all those metrics correlate to, and what will give you the highest probability of getting the most growth. So what we'll do then is say, okay, let's go look back. Say the equity extraction time point, like they want to extract enough equity out of the property in 5 years to be able to fund a deposit of X amount and pay all costs. You will go then and look back, okay, 5 years ago, what properties were at 700,000? What grew by the amount that we're looking for it to grow at? How can we limit the risk as much as possible? What were the fundamentals of that area during that time? What was the days on market doing? What was the stock on market doing? How much inventory was there? How was it trending? What was the socioeconomics of the area? How affordable was the area? And you can actually just splice this down with data quite quickly, quite easily, using the hashtag software that we use. And what we're essentially trying to do is just increase the probability of a better outcome for the client. It's you know, a lot of people just look at that and go, that's just way over my head and I don't understand it. And like, look, you don't need to go and do the work. You need to pay someone that has spent, you know, the years looking at it to do it. But, you know, just talking to your friend at the barbecue and saying, I like this area. There's a bit more to it. You know, there's 15,000 suburbs in Australia. And even, you know, just I want to invest in my backyard. Like, I get it. And I've invested in my backyard. I still own property here on the coast. But let's say you're looking at 15 suburbs that surround where you live, right? And you're like, that's my pool of suburbs that I want to invest in. Well, there's 15,000 in Australia. So you've got a 1 in 1,000 chance of picking the best one. You know what I mean? So, you know, like there is, there's just so much information out there at the moment, like so much data, like census, they do all of that data from census, right? They look at like your education levels, they look at what the occupations are in the area, they look at the median household income, and they score it from 1 to 100. Sometimes we put it down to 1 in 10, but you can actually tell when you look at these heat maps, right? You can say, I'm going to look at the Sunshine Coast and I can say, okay, that area is a 10, that area is a 2. And you go drive around the streets that are a 2 compared to driving around the streets that are a 10, like you can feel the difference. There's a difference,
you can see it.
You can see it. So like the notion of not being able to pick pockets inside of suburbs just from your computer screen these days is somewhat BS. Like, you know, you can go on there quite easily and find where the public housing is, where the socioeconomics are higher and lower, and then you can compare that with what the average price is here, and here, and you can create a bit of a picture. And then even once you do that, like you can just use Google Street Maps and drive down the street. And it's like almost exactly the same. And
is that publicly available, or is that stuff that you've got access to? Right, okay.
A lot of that is publicly available. You can get that data. The public housing maps you can. Socioeconomics, so the Elsayed score, the Index of Relative Social Advantage and Disadvantage, they call it. That's publicly available data. It's like a bit messy going through those websites. The one, you know, the couple pieces of software that we use sort of pull that all together to make our job quicker and easier to use, because, you know, there's a lot of, like, our process for pre-due diligence, you know, like before we even get to a point of presenting a property to a client, like obviously it's not very professional for us to go and just say, oh, do you like this property, and send like realestate.com.au links and then go, oh, you did like it? Sorry, it's actually in a flood zone, you know, like that's not a good look. We don't do that. So we'll go on, we'll say we're buying a property and we're looking for something that's got granny floodability on the back. We will go on there and we'll check flood, fire, bushfire, heritage overlays. We'll check for any easements in the backyard that could restrict that. And then we'll get tools to draw up to make sure that it actually fits. We'll go get quotes from granny flat builders. We'll go we go do so much work before we even get to the point of presenting the property to a client. Because once we've presented a property to a client with all the figures, the cash flows, everything in there, rental appraisals, checked easements, we want to buy. You know, like we're not. It's investment property focused. It's all about the numbers. So. Yeah, there's a lot of work that goes into it. There's 30 checks that we do before we even present a property to a client.
And of those 30 checks, how many could the average punter do without the services of a buyer's agent or similar?
You probably could get through a few chunks of them in most councils because there's a lot of council maps available. Like, you can get them. Yeah, you get through a lot of them. I guess the other thing is too, like, we've got relationships and we actually will pay, like, on retainers, our builders for granny flat quotes and things like that, so we can get them back quickly and easily. And especially when you're buying in a hot market, like, time is really important.
You've got to be quick.
Yeah, you know, we can go and get 2 or 3 quotes for granny flats, or, you know, re-stumping underneath the ground, and within a couple of days, and be back there and be ready to bid and buy. And if you don't move that quickly, you miss out.
Which suburbs do you think are most likely to grow in the next, say, 3 to 5 years?
Okay.
Let's go Sunshine Coast and then Australia wide. Where do you like on the Sunshine Coast?
Okay, on the Sunshine Coast, look, I think Namble's probably got a lot left in it yet. I think that Beerwah probably will have a bit more of a run yet. I think the unit market's going to continue to do quite well. And the reason why I say it's going to do quite well is because there is a lot more buyers in that pool, in that price range. Interest rates will have a lot to do with it if they come down significantly, and that affordability, you know, if it's more affordable for more people at that $1.36 million range, which is the average median house price on the Sunshine Coast at the moment, then they will create more competition. It's funny though, right? Sunshine Coast is has got really high socioeconomics. It's an 8 out of 10. A lot of people move here for lifestyle, and I don't think there's a lot of investors coming here and buying stuff with a 90% loan to value ratio. A lot of people are paying cash for their houses, and they will continue to go up. But yeah, I would say Nambour, Beerwah. Don't know. That's probably just those two is my favourite, I would say.
Yeah. Do you know? I think, you know, if it was 4 months ago, I'd be a lot stronger in this statement. But North Budrum, there's still some good value in North Budrum. They're big flat blocks. You know, they were early ones. They're kind of more early to mid now, but there's still a little bit of value there.
It is a nice pocket.
It's beautiful.
It is a nice pocket.
Yeah. Wide streets, big blocks. You know, they're all. It just feels nice, doesn't it?
You can probably pick up a 4-bedroom house for about $1 million there still, or not quite.
Yeah.
Needs some work.
One that needs some work. Yeah. There was an auction there recently, 3 months ago. Everyone was expecting a 1.1 to 1.15.
Yeah.
It went for 1.305. That was a big result.
Yeah. Wow.
14 registered bidders.
Yeah. Wow.
And you know, in my eyes, that was the day that North Budrum kind of just took that step.
Yeah. Sure.
Yeah. Set a precedent.
Yeah. No, that's good.
What do you think of Kaluan?
I think Kaluan's really, really good. Obviously, there's like certain pockets of Kaluan that are much better than others.
Yeah.
There is obviously the treatment plant. You don't want to be too close to that. You can get woofs of smell in some pockets in Kaluan, but and you don't want to be too close to the motorway either. Like there is some houses that back onto the motorway there, and the road noise is not great. But all in all, I think from an affordability point of view, in comparison to most other suburbs, it's really quite good, and it's pretty much Maroochydore. It's just got a K in front of it.
Geographically, it's amazing. It
Yeah.
sits between Budrum and Maroochydore.
Yeah, it's nice and close to CBD. I think you'll never, like, the vacancy rates will always be really good there. Like, you'll never have any issues renting out properties. It's probably a great spot to do, like, a co-living type property, I would say, because it's close to the Sunshine Plaza, close to CBD. You're always going to have those young professionals going in there, renting out rooms there for $400 a week. You could do, 5, 6, 7 separate rooms in a co-living place in a brand new build. Still get the appreciation of the uplift in the land value because it's where it is. But there's not a heap of land there available. You probably have to knock it down.
Yeah, we've got one block left.
Yeah, that's really close to the highway though, right?
It is. But
priced
accordingly.
That, to be honest with you.
Priced accordingly, and built to that standard with all the acoustic. What's the word?
all the acoustic walls, yeah.
Yeah, built to that standard with acoustic walls, double glazed glass.
Yeah.
You know, it's not that bad.
I mean, it's
elevated too.
It's got its place, right? Like,
yeah.
And this is the thing, a lot of people, and like, look, I don't either buy, like, for my clients, typically close to a highway, close to train tracks. We try and keep away from those, like, noisy situations. But when you actually slice the data down, like which I do, and you actually have a look at it, if you look at things on a percentage basis, they don't actually underperform or really at all in comparison to other properties. Where that statement is true is just not buying wrong in the first place, right?
Totally.
You can't go and look at the house that's next to the train tracks and then go and find one that's 600 metres away from the train tracks and pay the same price for it in the first place. But if you buy it accordingly and you understand what the value is of that there, and then it goes up, it'll probably go up at the same rate, but it'll always drag behind.
Totally.
So, yeah, look, it's
all relative.
Exactly right.
Yeah.
And then Australia-wide?
Yeah.
So, okay, I don't really like answering these questions because we will pick like a different suburb for every client. And the reason why we do that is because we do property portfolio planning. So if your plan is to build a property portfolio, then it's all well and good getting into an area that's the next hotspot, which a lot of people do, just put people into the next hotspot. But if you get into an area that has really substantial growth over the next 2 to 3 years, and then it flattens out, and your plan is to hold it for 10 years, then you're better off getting into the other suburb that has consistent growth like that over 10 years, and you end up in a higher net position. But then taking it another step further from that is actually sitting down with the mortgage broker and understanding that if my rents go up on this property by X amount, if my income goes up by X amount, or if I pay down my mortgage here, when will I be in a position to buy again? And if they say to you, you'll be in a position to buy again if interest rates stay the same, everything's equal, no one's got a crystal ball, but you try and plan it as best you can, they say you'll be in a position from a serviceability point of view to buy in 4 years. Okay, great. Let's try and find a suburb for this client that they're going to get to their equity extraction time at that point. In other words, it's another word for getting 30% out to pay for this deposit on the next property and costs. And so that way then, when we get to 3 years, you've got the deposit and you've got the serviceability, so then you can buy again. That way you can strategically do it. And by getting into an area where it does, in 3 years you get that 30% rather than doing it in 2 years will mean that the longer term averages of that property is more likely to be better because the probability of getting into that suburb at the bottom of the property clock cycle is higher, right? It's not already booming. You want to get in at the start of cycle as much as possible without getting in too early and then not being able, and then being on the other side of the circle where you've got the serviceability, but you haven't got the deposit to be able to fund the next deposit for the next property. Mm-hmm. So that's a long-winded way of saying I don't like answering that question. But if you're looking about 2 or 3 years and you're looking about 2 or 3 years, you're not taking any risk into account. And I wouldn't buy here, and I'm not buying here. I reckon Northern Territory, Durack in Northern Territory.
Durack.
Yeah, so
Darwin, is it Darwin or is it somewhere else?
It's in Darwin, yeah.
Okay, yeah.
Now, look, and I'm probably going to be wrong, but the data there at the moment is really, really good. Like, you can actually buy a house there and it'd be positively geared right now.
Wow.
Which is very, very hard to come by.
Yeah.
At the moment. Pretty new builds, you can get stuff with it. So pretty new build, low maintenance, you can get all the depreciation benefits. You go on realestate.com and try and find a property for sale there. Like there's none. Like they're all selling off market before going. It's going crazy.
Wow,
it's going crazy. But it's been sitting flat for so long.
Totally. Yeah.
And you wouldn't I think it looks really good for the next 3 to 4 years, maybe 5 years. But then after that, I wouldn't want to be getting out.
So what was the catalyst for Durack? It's sitting there doing nothing for a decade, and now all of a sudden it's hot.
When you look at all the data, I'll pull it up. So in the last year, the capital growth has been 7%. So it's just starting to warm up. The Elsayed score is 9 out of 10. So the socioeconomics there are like really, really good. It's higher than the Sunshine Coast.
Okay.
Right.
So it's the place to be in Darwin.
It's the place to be in Darwin, right?
Okay.
It's got better socioeconomics than the Sunshine Coast local government area as a whole, right?
That's wild.
So there is people that are educated there. There's people there on good incomes. There's good schools there. The affordability index for the area is 23 years. In other words, if the median household income there can buy a property with just a 20% deposit and pay it off in 23 years.
Yeah.
In comparison to the Sunshine Coast, it's 72, 73 years.
So
it's just
four times as affordable as the Sunshine Coast. 4 times
Pretty
more
much.
affordable, roughly.
Pretty much. 3 to 4 times, yeah. It's just insane. And then, like, when you look at the actual stock market, and I'll pull this up, it's been nosediving over the last 15 years, and in the last 5 years, in the short term, it is just, like, down. Like, there's only 2 listings on the market in the whole suburb. If the days on market on average is 40, but I know it's actually less than that, there's probably just 2 properties that are way overpriced or have got something wrong with them.
Yeah.
But basically, based on that, like, it's only got not even 2 months. It's got 0.19 months of supply. So, like, it's a week of supply. Vacancy rates are 2%. And then, like, this is the thing that's just... The rental yield on average is 5.54% on average. But if you look at the 3 bedrooms, like 5.7%. You go put a granny flat or something like that. Like,
you don't?
No, you could. If you got a property there, put a granny flat on it, or rent it out the rooms room by room to, manufacture some yield. It's really, really good. But buying in an area, it's like buying in an area where your equity extraction time point is 3 years is a lot different to buying in an area where you got to sell in 3 years. Mm-hmm. The reason I say that is when you pull out equity, it's tax-free money. You're not paying the stamp duty again to get into another property. You're just holding on to the property, and you're not paying the capital gains tax.
And is
Durac
Durac
selling fees?
Is Durac something that you're selling in 3 years or extracting equity from in 3 years and holding for the long term?
I would be very nervous holding it, and the reason why I say that is if you look at the 15-year chart here, it's like, I'll show you, right? In 2009, the typical house price was $536,000, and you fast forward to 2020, which was over 11 years later, it was $460,000. So imagine holding that. You lost $60,000-$70,000 in 11 years. So no, holding it for a long time is not. Suburbs like this is just like so risky. But if I had to take a punt, it's probably going to have a really good run. Too risky for me. Way too risky for me. There's some good areas in ACT at the moment, which is actually quite surprising. There's lots of like really good safe areas in Victoria. Geelong's like I'm not investing in Geelong. Okay. I did that video on Geelong, which is probably what you're referring to. Geelong's socioeconomics and like median house price was a really good direct comparison for Sunshine Coast. Yeah. That's why I picked that. Yeah. I'm not actually investing there personally or putting any of my clients in there.
More so the other side, yeah.
Like regional Victoria yields are make it a lot more easy to breathe. Like the cash flow on them is pretty decent. Like with this property that, providing we do settle this afternoon, providing it does go unconditional this afternoon, once we put a granny flat on it, will be cash flow neutral at an 88% loan to value ratio in about 12 months. There might be some maintenance costs on that property that will blow that out for a little bit longer yet, but regional Victoria, the yields are pretty good because when you get in a bit closer, the yields can be quite challenging in Melbourne for the average income owner. Mm-hmm.
What do you say to people who ask, should I buy now or should I wait for the market to drop?
I say that I would tell them to go and look at a price chart over the last 15 years or 20 years, the biggest one that they can find online.
I've got a 60-year one.
A 60-year one. Find the longest one that you can find over, and go to your suburb, right? That way I'm not telling you some bullshit. Right? Go to the suburb that you live in. And if you sit there and go, year one, did it go up or down? And then get a whiteboard and chalk up and have another line saying down. And go, all right, 2010, yep, we went up. 2011 went up, 12, and then you can just look at it and say, is there more ups or there's more downs? And then I would say that the probability of it going up is probably going to be down because there'll be more chalks on the whiteboard on the yes side.
Absolutely.
So, buy now. I mean, if you keep trying to save and you're not saving at the same rate as what the growth of the property is going at, which is very, very difficult, well, then, you're probably not helping yourself out.
And I guess that leads into buying wherever it is you can afford.
That's right.
And getting in.
Just get
now.
into the market.
Yeah.
Look, I mean, if you can afford to buy at home, you can take advantage of some of the grants, and you are in a suburb that does have decent data, then it can be advantageous to do that. Especially now, like there is some lenders like Combank, for example, they will actually take in like your second and third room rental for the rooms onto your serviceability calculations, so it can allow you to get a little bit more debt. But yeah, look, just get into market, get into whatever you can, and I rent where I own.
Yeah,
it makes sense, right?
Yeah,
living in a $1.5 million property, and it's costing me $700 a week.
Totally.
It's just a no-brainer. The yield on that's like
2.5%. I've got a fantasy, so to speak, where I sell everything I own and just buy a dozen investment properties.
Yeah, I mean, you thank yourself for it in 10 years.
Totally.
Yeah, I mean, especially, and honestly, when you've got a good chunk of capital, that's when the that trust sort of scenario works so well, because you haven't got a deposit issue, you've got a serviceability issue. Like, even if you are making $500,000 a year, you're going to cap out at some point in your personal name.
And so for the average person making a third of that, the ceiling's pretty low.
Yeah. I mean, I think, it's like less than 5% of Australians get past their third property. They get stuck. And honestly, that's the main reason why. It's just the bank's serviceability calculators. They have to... It's a responsible lending legislation. Like, it's there for a reason. Once again, it's not for everyone to go and do the trust structure. And there's more costs involved too. Like, typically the interest rate will be slightly higher. You have got fees to set it up. You've got ongoing fees for like $2,500 a year, roughly, to keep ASIC happy, to keep your accountant happy, to keep the ATO happy. You don't get the negative gearing benefits. They get trapped inside of a trust. So if the property is very negatively geared, you're not going to be able to get that tax refund each year. So it can be a bit of a cash flow burn, and it's only got to be implemented for the right people and the right strategies and the right properties.
And why do you think you do get a worse interest rate?
Not really sure why, to be honest with you. I don't actually know.
It's fucking annoying.
It's not that bad. I had a client the other day. We bought one property in his... Hang on, let me get to this. Yeah, okay, so first property bought with ING for 6.04% interest only, 4 years interest only, at an 88% loan to value ratio. He can now, and that pretty much capped his serviceability, right? Now, even with capped serviceability in his personal name, he's managed to go and get another loan in a corporate trust structure through First Mac at 6.19%.
Wow.
So it's not that bad.
No.
And he unlocked another $600,000 by doing that.
Wow. 0.1% difference.
Yeah.
Ish.
Yeah.
Yeah.
Yeah, it's I was actually really impressed with that, but there's a lot, and they're pretty much a non-bank lender, right? They're not your big four, that's for sure, but there's just so many options out there at the moment, and that's why it's so important to use a good mortgage broker.
Yeah, I've got a really good rate with ING.
Yeah.
5.39.
That'll be
for investment.
P and I though.
Yes.
Yeah, and you wouldn't be on 88% loan to value ratio.
Not anymore, no.
Yeah. See, the more obviously the more deposit you've got in the deal, the more security the bank's got, so that I will give you a lower interest rate. But yeah, at 88%. I mean, ANZ's doing 97% loans at the moment.
Wow.
Yeah, that's pretty wild. But the interest rate jumps up to 7.2 or 7.3 or something. It's getting up there.
Do you think it's never been easier to get into the property market, generally speaking?
I wouldn't say like there's people who I seem to be on either side of the fence with this one, right? Someone's like it's the best time ever, or like there's never been an easier time, or it's impossible. I don't think it's like much harder than what it has been in many other decades before. To be honest with you, I think that people don't know how to sacrifice and they don't save. I mean, you only need to you go walk down Mooloolaba. And you go down one of the streets where half the street's being knocked over and half the street's being new houses. Like, everything's bigger, right? The houses like next to them, they're just the tiny little houses, and everyone just thinks, oh, this is the big one that I need now.
Yeah.
Everyone's got their phone, everyone's got access to everyone. Everyone, like, have a look at your Uber Eats. Like, people aren't saving. The hardest thing is getting that first deposit. But there's a bank of mum and dad that you can use these days where they go guarantor if you can't get the deposit together. There's saying said that do 97% in loans. Like, you don't need to get that much money together. I think if you live somewhere like the Sunshine Coast or Sydney or in a capital city and you want to buy your own place and you want to buy a house and median house price is 1.5 million, then yes, it is harder than ever. But
there are options.
But there's
you need to explore.
You can still buy a property for 200 grand. Like, I wouldn't recommend it, but you can. Like, you can still
Totally.
buy little units at 200 grand.
Yeah.
So, yeah.
We were looking at units earlier this week, and there's 2-bedroom units in Caloundra in those little kind of 12-pack brick complexes in the 6s.
Yeah. And honestly, they're the best asset to buy anyway. Low body corps, you still own a good portion of land. Like, 12 is probably the max I'd want to really go to. But yeah, like, and that's what I mean. I think it's that market on the Sunshine Coast that'll probably do well rather than a suburb in particular. And I just think it's just because there is more buyers in that pool, there'll be more competition, there'll be more demand, right? It all comes down to supply and demand.
Yeah.
And because the building costs are so high at the moment, there's not that much supply of that sort of product coming to the market.
Yeah, nobody wants to build. We've got a few land listings, and they're slow.
Yeah.
People are traumatized by all the building costs blowing out mid-build, and people are scared to build.
Yeah. Oh, and also too, I think just, like, if you're a developer and you're... Put it this way, the developer can't go and buy the land and build even a low-spec property that is the same spec as one of those brick ones renovated for what you can pay that 600 grand for. They can't turn a profit at that point. So I think, there's no more stock coming to the market of that product at that price range. There's lots of buyers in that pool based on what the median household income is and what the interest rates are right now, what people's borrowing capacity is. So I think that market there will probably go up on a percentage basis best, It's not going to go up the same amount as a $3 million house if you're talking about a dollar figure. But on a percentage basis, that would be my call.
It just looks very cheap. It just seems like something that'll be worth $1 million one day.
Yeah.
A 2-bedroom unit with A-grade location, really. Yeah.
I think in particular too, like I think the ones that are on the ground level, I think they will be pretty sought after.
Because a lot of those don't have lifts, do they?
No.
They're all walk-ups.
That's right.
Yeah.
I mean, you're always going to get that younger generation that are going to buy that stuff, but that's only half the market.
Yeah. And what kind of yield would a unit like that have? Say 2-bedroom, 1 bath, a couple of streets back from the beach in Caloundra.
Probably low 4s would be my guess.
Yeah, okay.
Yeah, I'd have to have a look at it. We don't buy really on the Sunshine Coast for our clients typically, so I'm not all over it top of my head. Yeah.
Do you want to talk about the town plan? Have you looked at it, the new town plan, or not really?
Nah.
Right.
You can. I'll just hit you with it.
It's all right. It's probably a episode in itself.
Okay.
It's pretty gnarly.
Yeah, right.
Yeah. Half of Bedina is going to be medium density.
Yeah, and I think it's like all down Nicholson Way and all down Brisbane Road or something. It's all changing, right?
Yeah, I haven't really looked at Brisbane Road, but all along Nicholson Way, northbound from pretty far south, the entire the entire pocket, that Marrowa pocket where you turn left off Nicklin Way, all the front of like Chelsea Crescent, Hugh Court, everything in there is all turning medium. Jarrah Street is all turning medium. They went really hard. Yeah. Basically all of Bedina south of Kawana Shops.
So what height restriction is that, 12?
Yeah, the height restrictions change a little bit, but a lot of it is 12. Yeah. So technically speaking, if you bought a house there with the intention of living in it for 5 years and then pushing it over and building a home for your family, that may not get approved. In Bedina.
Wow.
And then, you know, they went really hard in around the beach and they didn't do a lot rurally. Like last time this happened, a lot of Palmwoods and Woombai went from, you know, rural res to low density. And there was, you know, developers were able to cut off a lot of blocks and do little estates. And that's, you know, where you've seen a little bit of sprawling out to Palmwoods and Woombai. There was not a great deal of that at all.
No.
You know, we saw 5 blocks in Palmwoods, 5 in total,
Right.
that went from rural to low density. There was 1 in Didillabar that went from rural to rural res.
Right.
Yeah.
Big
yeah.
one though?
Yeah. That'll turn into maybe 14 blocks.
Yeah, okay.
Yeah. But yeah, they very much went for the up, not out.
Yeah, right. Yeah, no, I haven't really glazed my eyes over it as much as I should have, to be honest with you. No. Yeah, well, that's pretty impressive.
There was a lot of pushback around Kawana.
So what's your take on that? Would you buy in there now, or how far close is that to your place?
Right there, yeah.
We're
We weren't affected. You know,
Okay.
the front of my little pocket was affected. The other thing they did was removed all the protected housing overlays from Minyama, Pariera, Budrum. The protected housing overlay restricted duplexes.
Yes.
So now there'll be a lot more duplexes.
Yeah.
But what they did as well, which I guess counteracts that a little bit, is rather than so basically at the moment you can't put a duplex next to a duplex.
Yes.
Technically every second house could be a duplex.
Yes.
Now there's like a 100 meter radius.
Yeah.
Yeah. So there's more options for where you put a duplex, but there'll be less in total.
Gotcha.
Which I think's good.
Yeah, I think that's fine.
It makes a lot more sense. But yeah, I think they went way too hard in and around Kawana. And, you know, a lot of people's first thought was, you know, the opportunity that it's going to present. But there's no scarcity. You know, if you go and buy one of those blocks and sit on it, it's like, who cares? There's 100 more.
Yeah, and you'd want to get your DA in nice and quick because if somebody else has within 150 metre radius.
Yeah, well, that's the duplex thing, but more the medium density thing.
Yeah.
Like, there's so much medium density now. You know, that used to be scarce, and it's just not anymore.
Yeah.
And when no one wants to build anyway, it's like,
What's the point?
it's not going to be this mad rush that a lot of us thought it would be. To try and secure these properties that have just been rezoned.
Yeah.
Because there's hundreds.
Yeah, right.
It's interesting.
That is very interesting.
You know, it's not like if they just did like 2 streets,
Yeah.
it'd be like fucking go.
Yeah.
Get one. But literally half of Bedina.
Wow.
Yeah.
But I mean, there's still plenty of demand. Hey, like there's
Yeah. You know, I think the
just that building cost. It's the only thing that's really holding that back, isn't it?
exactly.
Yeah. Still going to have to be that really that real high level property, isn't it? Real high quality properties, isn't it?
Yeah, it's interesting, you know, all the duplexes that have gone up recently are all very high end. And a lot of the time they sit on the market for a lot longer than one might expect. And I think it's because, you know, there's not a huge segment of the market that have $2 million to spend that want a duplex. You know, we're not really there yet as a culture, I guess, as a people. You know, in Melbourne, everything's a duplex. It's normal.
Yeah.
We're not really there yet.
And I think also too, like just the weather in general, like you spend more time outside in Queensland, right? You know, so you do want a bigger yard and you do want the bigger pool.
Yeah.
In Melbourne, you hardly go in the backyard, so
yeah, and you know,
fundamental difference.
Those that do have $2 million to spend and do want a smaller house don't want stairs because they're getting ready for that next chapter where you know they don't have the knees.
Low maintenance, but yeah, you want to be on a flat land still.
Yeah, so the duplex thing's been interesting to watch.
Yeah. So duplexes with lifts, but then the price blows out.
Got to have a lift.
Yeah. Ah, good. Mate, I reckon we'll wrap it up. What do you reckon?
Sweet, bro.
Thank you,
you.
mate.